For longtime viewers of my channel, you'll likely recognize two high-yielding stocks that I cover from time to time in which I criticize pretty heavily. The reason I do so is because these two investments are extremely popular with investors who are brand new to high-yield dividend investing. A good number of people who are first starting out with income investing usually hold one of these two companies, and they all either lose money or they significantly underperform, depending on when they bought their shares. The first company is Armour Residential, ticker ARR. This 15% yielding stock pays monthly dividends, which attracts a lot of people who don't go much further with their analysis when they need to. A lot of people who buy this stock don't seem to recognize the fact that its share price has dropped nearly 95% since their IPO, and they've gone through a dividend cut almost every year for a decade. Now, some people will buy shares of ARR and claim they've made a good profit, but that's only because there can be short periods where this stock is profitable. If you wait long enough, history will repeat itself and you are likely to lose money with this stock. The second company I criticize pretty often with a very similar pattern is Orchid Island Capital, ticker ORC. Just like Armour Residential, Orchid Island is in the exact same mortgage business, and oddly enough, despite the fact that these are two totally different companies that aren't owned by the same company, they both come from Vero Beach, Florida, which I'm assuming must be a pretty awful place. This company has also lost a significant amount of shareholder value over time, and they've gone through almost as many dividend cuts as Armour has. But there's also another terrible high-yielding stock that also pays monthly dividends that I've never recommended before. I've known people who hold it for speculatory purposes, in which I was a little more understanding because they haven't gone through quite as many dividend cuts as the other two companies we just looked at have. But last Friday, some pretty damning information came out on this company that I think could actually have legal consequences for them and their board members. Based on their latest earnings, it appears that some of the information this company was providing might have actually been misleading investors for a long time. I think it's also a good time to talk about this company because given the surge in the stock market recently, some investors might be more willing to consider investing in this stock when I don't think they should. So people, in my opinion, need to know what's going on with this company before thinking now might be a good time to buy into it. The company we need to take a serious look at is Prospect Capital, ticker PSEC. They're a BDC that's been around for well over 20 years at this point, and you're likely familiar with them if you watch this channel. Before getting into the new information we learned about them on Friday, we really do need to go back in time really quick. For many years, this BDC has been under some pretty bad criticism for their poor management. According to a Wall Street Journal article that was published many years ago at this point, this company's CEO was getting paid as much as $100 million a year in compensation. That's significantly more than the average CEO in this sector makes because this BDC is known for charging a much higher than average expense ratio than the industry average. It's important to understand that these business development companies are actually pretty similar to ETFs or private equity funds. They hold investments, which can include debt and equity positions in small and medium-sized businesses, and they charge an expense ratio on the assets that they hold. That's how this company's board of directors get paid, and obviously the larger the portfolio of investments and the higher the expense ratio, the more money you get to take as a manager. Fast forward to August of this year, in which Prospect Capital became the target of another hit piece. Bloomberg published an article titled "Private Credit Fund Burned by Risky Bets is Bleeding Cash," in which they detailed the poor management of this BDC. The report started off by stating that many of the companies that have borrowed from Prospect Capital have been having a really hard time paying them back in our high interest rate environment. As a result of this, Prospect had been accepting payment in kind or PIK arrangements instead. These are when a lender goes to collect money from their debt, but the borrower doesn't have the money to pay the lender. So instead, Prospect Capital in this case will look at them and say, "Alright, well if you can't afford to pay us, we'll issue new debt for you to pay us later." And as a result of this, the company is actually allowed to report this as income. Bloomberg understandably saw this as a major issue. And although many BDCs do use payment in kind, including some well-respected companies in this sector, most don't use it to the degree that Prospect Capital has been utilizing it. Following the article's publication, the management team over at Prospect Capital issued a press release touting their company's highlights. These highlights included being one of the oldest BDCs in the sector, having a high insider ownership percentage, and they're focused on first lien debt investments. The company would eventually scoff at the Bloomberg article and assure investors that everything was just fine. I'd have to assume that this highlight they released undoubtedly made some people buy shares of Prospect Capital. On their earnings call a week later, John Barry touted their most recent developments and how strong the company's position was. And now finally, as we fast forward to less than 3 months later to November 8th, look at what's happened to Prospect Capital. First, a dividend cut of 25%, going from 6 cents to 4.5 cents per month. This is their third dividend cut in 10 years, which isn't as bad as Armour Residential or Orchid Island Capital, but it's still a 59% decrease in distributions over the last decade. Second, they reported a much greater than average fall in their company's net asset value. This is not a new trend as it's kept going down this same path for many, many years. So all of these new developments are terrible, especially given the company sounded so confident with their ability to manage their business following the Bloomberg article. Following this news, this company's stock has fallen by almost 20% in the last week. But their most recent quarter's performance alone doesn't make them the worst high-yielding investment. Again, there's other companies out there with even more dividend cuts and greater share price depreciation. But what we saw released on Friday actually revealed something that could actually be more diabolical here. The company BDC Buzz, which is a business that analyzes business development companies, made a couple comments following Prospect Capital's latest earnings. According to a public comment made by BDC Buzz, their latest earnings show that this company has been overestimating the value of their investments for years. This is obviously a serious concern. Remember, this company's board of directors make more money based on how large their investment portfolio is with their higher than average expense ratio. If a company is reporting, for example, that their portfolio value is $10 billion, but it's really closer to $8 billion, that's an extra $2 billion that they can charge fees on. BDC Buzz also believes that as a result of their latest earnings, that legal action could be taken against this company for their malpractice. If what BDC Buzz is speculating is true, that implies a few things. All of the allegations about Prospect Capital being a company that mainly exists to profit the board have a lot more weight to them. All publicly traded companies are supposed to operate in the best interest of their shareholders. In the case of BDCs, that should involve prioritizing NAV growth and at least maintaining their dividend. Not doing that and instead overstating your performance and collecting hundreds of millions of dollars in fees for yourself, as BDC Buzz said, is wrong. This also brings into question their use of PIK. Prospect Capital has touted having a very low non-accrual rating compared to the BDC average. But if they're arranging more payment-in-kind arrangements than average, how many non-accruals should there actually be? These arrangements would also be responsible for overinflating the value of their portfolio. So although Prospect Capital hasn't done as poorly as other companies, we need to ask some serious questions here. Is this the kind of management team that you want to support as an investor? Do you trust these people to prioritize your money and your investment performance over their own salaries? Does their overuse of PIK indicate their portfolio could actually be a house of cards? These are all things investors need to consider. There's a clear difference going on between Prospect Capital and the likes of Armour Residential and Orchid Island. These two companies suffer from poor performance in an industry that's difficult to thrive in, but Prospect Capital doesn't appear to be suffering from just poor returns, but rather something going on with their management team. With that said, I could just never entrust a company like this with my money. As I showed earlier, there can be periods where a bad company can perform better due to improving conditions. In the case of REITs, it's lower interest rates. But I would strongly advise people not to even consider investing in companies with management teams that prioritize the lining of their own pockets before their shareholders. And that's regardless of how well the stock market or the economy is doing. Even if Prospect Capital were to somehow turn their portfolio around and start reporting better returns, I still just couldn't trust this management team. But let me know your thoughts. Would you trust Prospect Capital with your money, or at least make a gamble on them, or are you trusting them right now? Or should these kind of investments be avoided altogether? Let me know in the comments, but with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.